Let's get back to the market coverage on this Friday morning. Joining us with some insight and analysis is Alan Nuckman. He's Chief Market Strategist at Bullseye Option. Alan, we have a positive theme this morning. We never know with these choppy markets where the end of the day will take us, but what's your general sense of the mood these days?
Positive. I'm trying to remain positive. There's so much negativity out there. We'll get to that in a second about the psychology, but let's look at where we are. Sunday, the markets will mark 1 month since we made the lows in the S&P. So you would never think so, just listening to everyone's concerns out there about what's happening. But we have seen a bottom base. Now let's see if that holds in place, and a series of higher lows and lower highs in all of the indexes. So we've got the Dow, the S&P, the NASDAQ, and the Russell with this pattern that could be a bottom in place that we can build on.
Well, let's talk about the sentiment that's out there. The economic worries with respect to the road ahead versus what has been factored into the market and how stock markets tend to navigate through this. What has your career taught you?
I am an old grizzled trader. I've been doing this for more than 30 years, all right? I've seen it all right? But I've never seen people have this loss of confidence in the markets and ever. And if you look at it, the VIX right now is at 25. So the market's telling us one thing, but consumers are telling us another thing about their worry. And I think a lot of people have talked themselves into not so much the recession, which is a word, okay, but an economic, downfall. And the reality is that rates are going to be at 3.75%, 3.5% at the end of the year. We know that. How we get there is the journey, not the destination. People have gotten themselves very concerned about that. But let's just talk about today. JP Morgan came out yesterday, 8.5. Morgan Stanley, 2.5. Citigroup, 4.5 today, and Wells Fargo, 3. Those are billions of dollars in pure profit for the quarter by the banks. Billions of dollars. Now, I put the half there, 8.5, because that's a big deal. $500 million is a big deal, at the end of those profits. That's how well corporations are doing. So, we're seeing growth for the quarter expected to be at 5%. Corporations are doing fantastic.
I'm glad you're getting into this because we are in a very key moment here. Now we're getting a flavor to your point about the banks. We'll start hearing from the technology companies. I'm just looking at what our friends at Bloomberg do, which is they tally up earnings expectations among the top strategists on Wall Street. And this is more than 20, like 23 strategists at various firms, and what their expectation for the year-end performance for the market is. And they have been tweaking those through the year. Now, there are those who are bearish who say, they're all too bullish. But these are updated estimates in real time. And right now, the average expectation on Wall Street is that the S&P will end this year 17% higher than where it is right now. But again, that plays into the equation of price and earnings. And we are busy with earnings right now.
Yeah, that's the crazy part, is that the prices come down dramatically. The PE ratio, stocks are cheaper than they've been. They're below the 10-year average. So, we've seen earnings continue to grow. Maybe the growth slows, but earnings are growing as price goes down. And that just, at some point, there's got to be some value here. Let's talk about some other things that people have been very concerned about. My father's a psychologist, so I'm licensed to talk about all these things, these concerns that people have psychologically. So everybody was worried about high commodity prices. Well, commodity prices have been knocked back down. Exactly what the Fed wanted to do. They got their intention. They knocked crude oil down. And we've got stabilization in the 10-year note. The 10-year note's now below 3%, solidly below 3% for the last weeks, and way off the high at 3.5%. So that's the markets telling us that that things are stabilizing out there as far as rates go. If you look at the futures markets in the short-term rates, that end of 2022, we top out, like I said, 3.5%, 4%. And then it's 3% in 2023, 24, 25, 26, 27. So, the markets have digested this, move forward, but people have not. And at some point, there's got to be some value here.
Let's stay on commodities for a second. I certainly have concerns for investors who heard everybody saying you got to be in commodities, you got to be in commodities. Right. It was a good news story for the Canadian economy or the Canadian stock, well, certainly parts of the Canadian economy like Alberta, but the Canadian stock market in the first half of the year. But it is troubling to see, I've said it a couple of times, I'll say it again this morning, with a snap of the fingers, a bear market in Canadian energy stocks. They lost more than 20% of their value in just over a month's time. That is a lot of volatility for people who are trying to make calls in the future, and they hear all the pundits talking about a tight supply market. But this recession conversation is really rattling the markets and moving money very quickly. Can you talk to the fast money? Is there an argument to be made that people took profits out of tech, put it into other places, once they started to make some profits in to a certain extent, maybe a fast money trade in oil, are taking it right back out again?
Money isn't made or lost, it moves. And it just moved from tech to the energy sector, to whatever was the strongest trends. And then you saw some profit taking. Now, I'm not saying it's over in the energies, but that was the exact intent of the Fed tightening. And the dollar strengthened that fast. Now, the dollar right now is at about the halfway point of where it's been in the last 35 years. So it's not strong, it's not weak. We're hanging around this 100 level, and we kicked up. But this might be the last gasp in the dollar because, like I said, the rates are already factored in farther out. So, how much stronger can the dollar get if we know where the end point is going to be in rates over the next year? So that's the concern. I don't think commodities are over. I look at this as a pullback. And that's why I'm an options trader, because I've been, in the commodities markets, like I said, for 3 decades. That's where I started on the trading floor. I know how those markets move and how quickly the tide can turn. And that's why I trade options, so you have limited risk and so forth. But yes, people have, taken profits. But you look at all those oil companies that doubled in value off the bottom, people took profits. So, if you got in late, unfortunately, you got whipsawed. But that's what happens when you have a really strong trend and you don't get on until the end. That's why it's always about risk reward. Look at stocks now. I'm a buyer of stocks down here, not a seller, just because of the risk reward.
Right. Helpful as always, Alan. Thanks very much. You're right about that whipsaw. Necks are getting sore out there. We'll see where things go from here. Alan Nuckman joining us as part of our market coverage. Obviously, we talk all about individual